What if I told you that the path to substantial wealth doesn't begin with $1 million inheritance or a high-flying tech IPO? What if the secret to building a robust financial future started with something as accessible as $1,000? Many believe you need a fortune to even dip your toes into investing. They think it's a game reserved for the already wealthy or for those with complex financial degrees. This common misconception often paralyzes aspiring investors. Today, right now, we debunk that myth with hard data and undeniable mathematical truths. Forget the gatekeepers. Your first $1,000 isn't just a starting point. It's a powerful launching pad, capable of unlocking exponential growth you might currently only dream of. This isn't about risky speculation or chasing hot stocks. This is about harnessing the most potent financial force known to humanity, compound interest. Often called the eighth wonder of the world, compound interest allows your earnings to generate further earnings, creating a snowball effect that accelerates over time. Imagine that initial $1,000. Picture it silently growing, year after year, decade after decade. It's not a fantasy, but a mathematical certainty when wielded correctly. We're talking about the very real possibility of seeing that modest $1,000 evolve into $70,000, or even an astonishing $150,000. This transformation happens not by adding more money, but purely by letting time and smart investments do the heavy lifting. This isn't magic, it's the beautiful, predictable power of arithmetic working tirelessly behind the scenes for your financial benefit. To truly grasp this power, let's look at a compelling hypothetical. Meet Investor A and Investor B. Both are 25 years old and stand at a financial crossroads. Investor A is an action taker. They invest their first $1,000 today. They then do nothing else, no further contributions, just that initial grand. Now, Investor B, also 25, decides to wait. They spend their $1,000 thinking they'll get serious about investing later. 5 years later, at age 30, Investor B finally decides to put their first $1,000 into the market. Just like Investor A, they make no further contributions. Both investors choose a diversified, low-cost index fund, historically averaging an 8% annual return over the long term. This is a realistic expectation for broad market indices. Let's fast forward to their retirement at age 65, 40 years after Investor A started. Prepare to see a stark difference emerge from their choices. Investor A, who put in that single $1,000 at age 25, would see their investment grow to a staggering $21,724. That's an impressive return indeed. But here's where it gets truly eye-opening. Investor B, who waited just 5 years, investing their $1,000 at age 30, would only have $14,792. This is their total by age 65. Think about that difference. A delay of merely 5 years without adding another dime cost Investor B almost $7,000 in potential wealth. That's a 32% reduction in final value simply for waiting. This dramatic disparity is what we call the cost of delay, an invisible tax on procrastination. This isn't just hypothetical, it's a stark numerical demonstration of why starting now with a small amount is exponentially more powerful than starting later with the same amount. The extra 5 years of compounding for Investor A created a financial chasm, showcasing the immense power of time in your investing journey. So, how do you harness this incredible force, especially when you're starting with a humble $1,000? That's precisely what this video is designed to uncover. Over the next 18 minutes, I'm going to provide you with a clear, step-by-step blueprint. This isn't about theoretical jargon or abstract concepts. We're going to dive into actionable strategies, detailing how to transform that modest $1,000 into substantial, life-changing wealth through accessible, data-driven compound investing. I'll show you exactly where to put your money, how to think about risk, and why consistency trumps sheer capital in the long run. If you are actually getting value from this video, please kindly consider subscribing to this channel and also like and share the video. It helps us reach more audience and doesn't cost you a dime. Let me be absolutely clear. This isn't about chasing speculative bubbles, trading risky penny stocks, or trying to time the market.
My approach, as always on Josh Invests, is rooted in leveraging time and consistent low-cost investments, proven reliable for decades. This makes them perfect for beginners and anyone feeling overwhelmed by investing's complexity. My goal is to demystify this process and break down barriers. I want to empower you to start building your financial future today, confidently and strategically. By the end of this video, you'll have not just the inspiration, but the concrete steps to turn your first $1,000 into a powerful engine for wealth creation.
You're ready to build that wealth creation engine, but how does it actually run? The secret, my friends, lies in the most powerful force in finance: compound interest. It's often called the eighth wonder of the world for a reason. Let's demystify this with a clear, calculable example. Imagine you invest $1,000 at a straightforward 8% simple interest. Each year, you'd earn exactly $80, nothing more. After 10 years, you'd have your initial $1,000 back, plus $800 in interest, totaling $1,800. The interest itself never earns more interest. It's a flat, predictable return. Now contrast that with compound interest, where your earnings start earning money for you. That first $80 isn't just sitting there. It gets reinvested, becoming part of your principal. So in year 2, you're not earning 8% just on $1,000, but on $1,080. This subtle difference is where the magic begins. This small, continuous reinvestment fuels exponential returns. Let's see what that means for your initial $1,000, assuming a realistic average market return of 8% annually. This is a figure we'll justify shortly. Year 1, your $1,000 grows to $1,080. By year 5, it's $1,469. After 10 years, you've more than doubled your money, reaching $2,159. The growth accelerates significantly. After year 20, your investment reaches $4,661, and after year 30, your modest $1,000 has blossomed into an impressive $10,063. Notice how the growth isn't linear. It curves upwards, slowly at first, then dramatically. This is the unmistakable power of time and compounding working for you. Now, what if we added a little fuel to this fire? Let's consider the profound impact of consistent, even modest, additional contributions to your investment. What if you added just $50 per month to that initial $1,000 investment? This small, consistent action dramatically alters the outcome. After 10 years, you'd have approximately $10,500, a significant jump from just the initial $1,000. After 20 years, that figure explodes to roughly $30,000. And after 30 years, you're looking at an astounding $80,000. That extra $50 a month, less than $2 a day, transforms your $1,000 into a substantial nest egg. It's your consistent effort compounding alongside your capital. So how do you actually achieve these 8% average market returns without becoming a Wall Street guru? The answer lies in accessible, low-cost investment vehicles. Think S&P 500 index funds or total market ETFs like VOO or SPY. These don't require stock picking, often a losing game for most investors. They track hundreds of large U.S. companies. They offer broad diversification instantly. Historically, the S&P 500 has delivered 7 to 10% annually over long periods, even after adjusting for inflation. This is ideal for beginners. These funds provide professional diversification and historical growth without complex, time-consuming effort. You simply buy a share of the entire market's long-term growth. This brings us to the ultimate payoff, the snowball effect. Imagine a small snowball rolling down a long hill. It starts tiny, picking up bits of snow slowly, but as it grows, it picks up snow faster, gaining mass and momentum exponentially. Your investments behave in exactly the same way over decades of dedicated compounding.
The early growth, while seemingly small, remember how that $1,000 only reached $2,159 after 10 years, becomes the crucial foundation for massive gains later. The critical point is that the last 10 years of compounding are often more powerful than the first 30 combined. Why? Your capital snowball is simply much larger. This isn't just a financial theory, it's a proven mathematical reality. It underscores why starting early, even with small amounts, is your most potent weapon in wealth creation. If you're actually getting value from this video, please kindly consider subscribing to this channel and also like and share the video. It helps us reach more audience and doesn't cost you a dime. Building on that mathematical reality, how do you actually put your first $1,000 to work and harness the power of compounding? It's far simpler than you might imagine. This isn't rocket science. It's a practical blueprint for action. Your journey to wealth begins with just a few clear, actionable steps that anyone can follow. First, you'll need a reputable brokerage account to hold your investments. We're talking about industry leaders here, like Fidelity, Vanguard, or Schwab. These firms offer low fees, robust platforms, and a wide selection of investment options, making them ideal for beginners. Once you've chosen your platform, the next step is to open the right kind of account. For many, a Roth IRA is an excellent choice, offering tax-free growth and withdrawals in retirement. If you've already maximized your Roth contributions or prefer more liquidity, a taxable brokerage account is perfectly fine. The key is simply getting started. After your account is set up, fund it with your initial $1,000. This is your seed capital, the foundation upon which your future wealth will be built. This initial sum, while perhaps seeming small, marks a profound psychological and financial turning point. Finally, invest that $1,000 into a low-cost, broad-market index fund. Think VTSX for Vanguard Total Stock Market or iTotal for an iShares Total Market ETF. These funds provide instant diversification across hundreds, if not thousands, of companies, mimicking the market's overall performance at a minimal cost. They are the workhorses of long-term investing. But the initial $1,000 is just the beginning. The true magic of compounding accelerates with consistent contributions. Set up an automatic transfer of $50, $100, or whatever amount comfortably fits your budget directly from your checking account to your investment account. Do this on a bi-weekly or monthly basis. This automation eliminates emotion from the investing process, ensuring you stay disciplined and continuously feed your compounding machine without even thinking about it. Let's bring this to life with a compelling case study. Meet Emily, a hypothetical but entirely realistic individual who decided to take control of her financial future. Emily, at age 22, began her investment journey with an initial $1,000 deposit. She then committed to adding just $150 every single month into a low-cost S&P 500 index fund. For our projections, we'll use a conservative average annual return of 8%, which historically aligns with the S&P 500's performance over extended periods. At age 32, just 10 years later, Emily's portfolio had grown to approximately $31,000. Her total contributions were $1,000 plus 120 monthly payments of $150, totaling $19,000. This means a remarkable $12,000 was pure compound growth, doing the heavy lifting for her. Fast forward another decade to age 42. With her continued $150 monthly contributions, Emily's account now stood at an impressive $85,000. Her total contributions had reached $37,000, meaning a staggering $48,000 of her portfolio was generated solely through the power of compounding. At age 52, her wealth surged to approximately $220,000. At this point, her total out-of-pocket contributions were $55,000, yet her compound gains had absolutely dwarfed that, contributing $165,000 to her net worth. By age 62, on the cusp of retirement, Emily's initial $1,000 and consistent $150 monthly contributions resulted in a portfolio exceeding $550,000. Her total contributions over 40 years amounted to $73,000, but the compound gains? An incredible $477,000. This is the tangible outcome of patience and consistent investing. However, I know what many of you might be thinking. What about market crashes? What if my investments lose money? It's a natural fear, but it stems from a common misconception. Market volatility is not something to dread. It's a normal, inherent part of long-term investing. Historically, markets always recover and reach new highs. The critical insight here is that time in the market beats timing the market. Trying to predict ups and downs is a fool's errand that typically leads to missed gains and emotional mistakes. Your best strategy is to stay invested through downturns. These periods, while uncomfortable, actually allow your consistent contributions to buy more shares at lower prices, accelerating your growth when the market eventually recovers. It's like buying stocks on sale. Finally, let's touch upon the subtle yet powerful force of dividend reinvestment. Many index funds pay dividends, which are essentially small portions of a company's earnings distributed to shareholders. When you set up your account to automatically reinvest these dividends, they are used to purchase even more shares of the same fund. This creates a powerful snowball effect, adding another layer to your compounding without requiring you to contribute any additional cash out of pocket. It's truly passive wealth acceleration, amplifying your returns over the long haul. Remember, your first $1,000 isn't just money, it's a commitment to your financial future. That $1,000 we've discussed isn't just money, it's the powerful seed for your financial freedom. It's capable of blossoming into tens, even hundreds of thousands of dollars purely through the disciplined application of compound investing. This isn't merely theoretical, it's a powerful mathematical certainty that has transformed countless lives. Let's expose the true cost of delay with a direct, undeniable calculation. Consider two individuals, Sarah, who starts today, and Mike, who waits just 5 years. Both plan to invest their initial $1,000 and contribute $100 monthly. The difference in timing, as you'll see, is absolutely staggering. Sarah starts today with her $1,000 and commits $100 monthly for 35 years. Assuming a realistic 8% average annual return from diversified index funds, her total personal contribution would be $43,000, $1,000 initial plus $42,000 monthly contributions. After 35 years, Sarah's portfolio would grow to an astounding approximately $245,000. That's over $250,000, primarily from compounding. Now, Mike, same $1,000, same $100 monthly. The crucial difference, he waits 5 years, investing for only 30 years. With the same 8% return, Mike's total personal investment would be $37,000, $1,000 initial plus $36,000 monthly contributions. His portfolio would accumulate to approximately $155,000. The staggering difference? Waiting just 5 years cost Mike nearly $90,000 in potential wealth compared to Sarah. This isn't merely $6,000 of missed contributions, it's $90,000 in pure compounded growth. This isn't abstract theory, it's the undeniable mathematical reality of how compound interest works. The earliest money you invest truly works the hardest. Waiting just 5 years could cost you tens, even hundreds of thousands of dollars. This underscores the absolute urgency of starting now. If you're ready to stop watching and start doing, here's your 3-step actionable challenge, implementable immediately. Step 1. Open a low-cost brokerage account. Think Vanguard, Fidelity, or Charles Schwab. These leaders offer excellent access to the low-cost index funds and ETFs, perfect for beginners. Step 2. Fund that account with your initial $1,000. This is your wealth seed, poised for exponential growth. Don't overthink it. Step 3. Set up an automatic recurring transfer. This is where consistency shines. Start with $50, $100, or more weekly or monthly. Make it happen this week. This automated discipline is your compounding engine, eroding emotion and consistently feeding your future wealth. The journey won't always be linear. Expect market fluctuations and headlines inciting panic, but the hardest part is simply starting. Overcome that inertia, and the most rewarding part is watching your compound engine kick into high gear, accumulating wealth over decades. Stay disciplined, trust the long-term process, and ignore short-term market noise. Let time, your greatest ally, do the heavy lifting. True wealth builds consistently year after year, not overnight. If this blueprint empowers you to take control of your financial future, I need you to take action right now. First, smash that like button to help this message reach more aspiring investors. Second, subscribe to Dividend Detectives for more actionable strategies and data-driven insights. Hit the notification bell so you don't miss a video. Third, share this video with someone who needs this clear path to financial independence. Finally, tell me in the comments, when are you starting your compound investing journey? What's your first step going to be? Your journey begins now. Check the description for recommended brokerage platforms, essential guides, and resources. Your future self will thank you for taking this crucial step.